Hello, this is Nick Rach with the Earnings Scout, and today I'm going to look at CVS Health's earnings revision trends and its recent stock price drop and determine if it's worthy of still owning or not. So when we look at CVS stock price over the past 6 months, the stock is down 13%. That calls into question, do you double down on the name given the price drop? Do you hold your position in it and maintain it? Or do you cut bait and give up on the name now that it's down and underperformed so much in 2016? We're going to answer that question really quick. So if you just want the answer, we have an indicator score of 76 out of a possible best 100 on it. So we're telling you to hold it. So if that's all you want to know on CVS Health, you can stop listening to this presentation because we make it that easy for you with the math. If you want to learn more of how we derive that 76 indicator score, let us show you how. On this chart here, we have a red line which is representing CVS Health stock price over the past 2 years. So you can see it was a $79 stock in mid-October 2014, rising as high as 112 and then falling back in underperforming ever since really the fall and late part of 2015. As we draw in the blue lines, though, these squiggly lines in here, we're drawing a line in here that's the zero line. Above this line, that means earnings per share estimates for CVS are going up on an absolute basis. We call this an earnings score when they're going up, and the earnings score when they're going down means the estimates themselves on an absolute basis are getting cut. The earnings scores that we measure here, the score itself measures the magnitude of those revisions. So it tells you by how much the estimates are going up or down. That's what we care about, the how much part, the magnitude. We don't merely care if earnings estimates are going up or down. We care if their estimates are getting better or worse, because you can see when the estimate trends are getting better. When the estimates were falling by 3% in one earnings season, then they're falling by 2% to the point where they're getting raised, CVS stock price rises. The stock price follows the delta to its expectations, earnings expectations. When the delta to CVS Health's earnings expectations goes negative, the negative slopes here, when they're going up by 1%, and then by early part of 2016, they're getting cut by almost 5%, CVS stock price justifiably falls, in our opinion, because the stock price should follow the rates of change to the earnings expectations. Now, in 2016, what we see here is the earnings expectations continue to get better. And at this point, you can see the early part of the year, the estimates were falling by that 5%. Now they're being maintained, maybe going down by a penny for the next quarter, not much, but mostly flat earnings, zero earnings score, while the price keeps going lower. This is a divergence. So we have identified a divergence here that didn't exist within the past 2 years. So this tells us either the sell-side analysts making these earnings per share estimates are either too optimistic and haven't cut estimates enough, or the buy side is too pessimistic, penalizing this stock too much. But at the very least, we've identified that a divergence and something to exploit. So let's zoom in a little bit here. This is the 1 year trend, because I want to look at this trend. What we draw in here is the slope of all of these earnings scores over this time. And when we have a positive slope, that means earnings trends are improving generally. And if you think about it, at the beginning of the year, the estimates were falling by that 5%. Now they're being maintained. So the estimates have been less negative. The revisions throughout 2016, less negative revisions means improving earnings expectations. It should mean a higher price, but it doesn't in this case. Now we're going to zoom into the 6 month. It's the same data, just zoomed in here, and you could see what was going on back in May when the estimates were falling by not quite 2%, but down there to the point they're being maintained here. So we have improving earnings expectations over the 6 month or the 2 quarter trend as well. And so what we want to do is identify improving earnings expectations in this falling stock price. This tells us there's an increased margin of safety. That divergence is going to create a margin of safety for us to exploit. And while the sell side analysts may be too optimistic, we also believe the buy side is being too pessimistic on the stock and pricing in the worst. At the very least, the sell side numbers can go down here, and the buy side has already reflected that. That's that increased margin of safety that we're talking about. This is why we give the indicator score 76 out of a possible best 100, because we get to buy improving earnings at a cheaper price. Now, we want to show you how the earnings indicator score has changed over the last 6 months, because this is telling too, and it tells you how our indicator score changes in time. If you go back to April, our indicator score on CVS Health was a 38. And the reason it was a 38 is because the price was moving up higher, but as the prices come down in 2016 and the earnings trends have stayed intact and actually improved, our indicator score has now moved to a 76. This is exactly the logic we want to apply, because if we get improving earnings estimates at a cheaper price, we want our indicator score to go higher. And our indicator scores above 80 is when we say buy the stock. So it's a 76 out of 100. We say you can at least hold the stock. If your indicators are also saying to buy this stock, then maybe you can double down on this. We don't have it tripped yet at this point. Certainly if the earnings estimates continue to improve and or the price drops, our indicator score will probably go above the 80 point, and we will tell you to buy and double down on the name at that point. But that is the logic on why we say hold the stock given the price drop. And again, if you have indicators saying buy with a 76 out of 100, we would confirm that as well, because you get to buy the improving earnings at a cheaper price. So there's the increased margin of safety for you. If you liked what you heard here on CVS, you can contact our sales and marketing department to learn more about CVS or any of the other 4,500 companies we have in our database, where we rank these across each other and derive our indicator scores. We also do this for every sector and industry. Thank you for listening. And again, contact us if you liked what you heard. Thank you.